Good morning and welcome to Bulls, Bears, and the Bell Weekend Edition. Today we are diving deep into, well, a really high-stakes, confusing, and frankly, absolutely fascinating market situation. A real paradox. Our core material is the detailed weekly market review and outlook, this one for the week kicking off October 6th, 2025.
Yeah, and this briefing paints a picture of, I guess, cognitive dissonance, doesn't it? It's quite something. On one hand, you've got the U.S. equity market just powering ahead, hitting fresh all-time highs, showing incredible resilience.
Right.
But on the other hand, we're smack in the middle of a full U.S. government shutdown. We're seeing economic data that's, softening a bit, and there are these underlying technical risks, warnings we haven't seen in, over a decade.
Exactly. So our mission today, it's really laser-focused. We need to distill what this market resilience truly means. We also have to identify those pretty loud, screaming technical warnings, and then preview the really high-stakes catalysts coming up, what the Federal Reserve might do next, and that crucial Q3 earnings kickoff. These could decide whether these record highs actually stick around.
And the central riddle for you, the listener, is really this. How? How can the market soar to these unprecedented heights while Washington is basically gridlocked and the overall economic picture looks like it's softening? We're essentially seeing a market that's celebrating bad news. And that contradiction, that's the highest risk, highest reward scenario playing out right now.
Okay, let's unpack this. Maybe we should start with the performance review. For the week ending October 3rd, 2025, it was pretty striking.
Yeah, looking at the tape, the performance was just relentless. Every single major index, the Dow Jones, the S&P 500, the NASDAQ Composite, they all notched fresh record highs. The S&P 500, it finished the week up about, 1.1%? Closed at 6,716. That's just pure, unadulterated investor confidence, at least at the headline level.
It is. It absolutely is. But, look closely at the fine print of that confidence. While the U.S. market was strong, global equities actually did even better.
Oh, really?
Yeah, the MSCI EAFE index, that's the one tracking developed markets in Europe, Australasia, the Far East. But excluding North America, that posted an even stronger gain, 1.7% for the week.
Huh. That's a crucial detail, actually, because it suggests the rally isn't just about those U.S. megacap tech giants that have dominated things for so long year to date. We might be seeing what analysts call broadening participation, capital flowing into international stocks, maybe other sectors too.
And that's generally seen as a sign of a healthier, maybe more sustainable bull market, right? Assuming it keeps going, of course.
It is generally a sign of health, yes. But the real marvel, the truly astonishing thing, was the political indifference.
Right.
This massive climb happened during the third day of a U.S. government shutdown. Normally, that screams instability.
Yeah, you'd think.
But the market largely shrugged it off. This is what we're calling the shutdown paradox.
So why so calm? It wasn't like Congress suddenly saw the light or anything.
No, not at all. Analysts were pretty explicit, actually. They were advising clients basically keep calm and carry on. And they were basing that advice purely on market history, not on the current political drama.
A market history dictating behavior then.
Pretty much. When institutional money managers look at a government shutdown, they tend to classify it as an episodic event, not a systemic threat.
Yeah.
Since 1976, we've had something like 20 shutdowns. And the analysis, it shows the S&P 500 actually rallied about half the time during these gridlocks.
Half the time. Interesting.
Yeah. And the really critical point is duration. Most shutdowns, they last less than 2 weeks. So for strategists, any market weakness caused by all the political noise, it just gets classified as a compelling buying opportunity. Buy the dip, essentially.
So the lesson is the market only really panics over threats to the financial system, not necessarily the administrative system.
That's a good way to put it.
If the financial plumbing is okay, the shutdown just becomes like background static. Okay, so if political noise was ignored, what was the engine driving stocks higher? We're back to that infamous bad news is good news thing, aren't we?
Precisely. That engine is running on, pure speculation about what the Federal Reserve is going to do. The main fuel for this rally was actually soft economic data. The weakening economic outlook wasn't feared. It was celebrated. Yeah. We saw the biggest drop in the ADP employment change since way back in 2023 that signals a cooling labor market. And that was paired with some surprisingly weak manufacturing and services reports, too.
And the market's interpretation of that weak data was like immediate and aggressive. Rate cuts are coming. Fast.
That's absolutely right. The market implied probabilities for a 25 basis point rate cut. That's 0.25%, just for context for listeners. for the October meeting, they rose to a staggering 97%.
97%.
97. And the probability for another cut in December jumped way up to 86%.
Wait, 97%? Isn't that really dangerous? I mean, that means the market has basically priced in a perfect super dovish outcome already. If the cut is already baked into the price, there's no upside surprise left, right, only downside risk if the Fed disappoints, even just a tiny bit.
It is incredibly dangerous. You've hit the nail on the head. That level of certainty about future easing, it's a powerful rocket fuel, no doubt. It lowers the discount rate for all future company earnings, which mathematically justifies higher stock prices today. But, like you said, if we're priced for absolute perfection, the penalty for even slight imperfection could be really severe.
Okay, so beyond the Fed engine driving things, we also have the calendar, right? Turning the page to October usually means something.
It does. It signals the start of that historically powerful Q4 tailwind. Since 1950, the S&P 500 has had a median gain in the fourth quarter of almost 5%.
Wow.
Yeah, 4.9% with an impressive 81% win ratio. So when you combine that strong historical seasonality with these really dovish Fed expectations, well, that momentum becomes very hard to stop.
And then there's the AI narrative still humming along in the background.
Oh, absolutely. Underpinning all this structural momentum is that enduring AI story. There's just persistent positive news flow about the build out of AI infrastructure that continued to bolster the semiconductor sector, which is, the clear market leader right now.
Right.
And major asset managers, including the biggest ones like BlackRock, they view this AI theme not just as speculative hype anymore. They see it as a pretty much guaranteed driver of future earnings growth and, importantly, long-term productivity gains across the whole economy.
Okay, so high-level view. Record highs explained by maybe three things. Political noise dismissed as irrelevant. Economic weakness celebrated as a reason for the Fed to cut rates. And the AI growth story providing that structural underpinning. But let's zoom out a bit, because the market isn't just one single thing, right? If confidence was truly universal, deep-seated, we wouldn't see these contradictions popping up in other asset classes.
Exactly. What's truly fascinating and maybe a little concerning is the complex and really divergent picture you see when you look across different asset markets. If this rally truly reflected genuine, deep confidence in economic stability, low geopolitical risk, all that good stuff, you'd expect capital to be flowing pretty uniformly into growth assets.
Makes sense.
But that's not quite what we're seeing, which raises a really important question for you, the listener. Why are investors seemingly taking massive risks and massive defensive hedges at the exact same time?
Okay, let's break that down. Start with the fixed income market bonds. That seems to align with the Fed story, right?
It does, perfectly. Treasury yields fell over the week. The benchmark 10-year yield ended lower, around 4.12%.
And why is that so important for stocks again?
Well, that decline in the 10-year yield is absolutely essential to the equity rally. Think of the 10-year yield as sort of the base interest rate for the whole economy. When it falls, it provides a crucial tailwind because it lowers the mathematical discount rate used to value all future corporate cash flows.
Right, the present value calculation.
Exactly. Lower discount rate equals higher stock valuations today, almost regardless of anything else. It's a mathematical lift.
Okay, but the commodity market, that's where things get weird. Schizophrenic, maybe?
That's a good word for it. You have two major commodities telling two completely conflicting stories about global economic health.
Let's start with oil. It looked weak.
Very weak. Crude oil fell sharply, dropped about 7.7% for the week, settling just above $60 a barrel.
What does that tell us?
A steep drop in oil like that. It's a pretty unambiguous signal of growing pessimism about industrial demand. Oil is, the lifeblood of global industry shipping, manufacturing inputs, plastics, chemicals, all that. This kind of drop suggests that bond traders and commodity funds, the folks really sensitive to economic cycles, are pricing in a tangible slowdown in global economic growth.
So while stock investors are high-fiving over a soft landing,
crude oil is actively pricing in the risk of a potential recession. Big disconnect there.
Yet the counterpoint is even more dramatic, isn't it? Precious metals. Gold.
Oh, yeah. Spot gold surge didn't just go up, it hit a fresh all-time high.
All-time high.
Yeah. And gold, as you know, is the traditional portfolio hedge. It's the ultimate safe haven asset.
So what's driving gold to record highs if stocks are also at record highs?
It signals profound underlying investor anxiety that clashes directly with the message from equities. This surge seems driven by, really, three powerful interconnected forces. First, just a classic flight to safety amid all the escalating global geopolitical uncertainty out there. Second, those persistent threats of new tariff policies that could disrupt trade flows again. And third, that strategic, long-term global trend of de-dollarization, where central banks around the world are deliberately reducing their reliance on the US dollar by accumulating physical gold reserves instead.
Okay, so here's the kicker then, right? This is the core paradox of the week we keep talking about. Simultaneous record highs in the S&P 500, the main risk on growth asset, and in gold, the main risk off safe haven asset. That doesn't feel normal.
It's definitely not typical market behavior. It creates what strategists are calling barbell positioning.
Barbell, meaning
Meaning investors are essentially long risks. They're holding growth stocks, betting on AI and those expected Fed cuts, and they are simultaneously holding massive positions in safe assets like gold to hedge against some kind of severe tail risk.
tail risk like.
Like a much deeper economic slowdown than expected or a major geopolitical shock, something like that. They're basically betting on the best case scenario while aggressively insuring against the absolute worst case scenario, all at the same time.
Which suggests the current calm we see on the surface. Maybe it's deeply deceptive.
I think that's a very real possibility. This barbell positioning, where you have strong bets on both offense and defense, it creates a kind of coiled spring for volatility.
A coiled spring, okay.
Precisely. The moment a significant negative catalyst pops up, let's say a surprisingly hawkish comment from the Fed, or maybe a big geopolitical escalation somewhere, both sides of that barbell could move, and move violently. You could see a rush to unwind those equity positions while people are also taking profits on their now successful gold hedge. That combination could amplify the sell-off way beyond what a typical market correction might look like.
So the market's built on this massive divergent hedge, creating this inherent fragility underneath the record highs.
That's the concern, yes. Fragility is the right word.
And just to quickly highlight how fragile things can get because of the political gridlock, we even mentioned the agricultural markets. Corn.
Right, good point. The government shutdown caused a data blackout for some critical USDA reports, including important info on corn stocks and demand. And this has created significant uncertainty there. Analysts worry that this data vacuum is masking potentially significant selling pressure from hedge funds.
Why would hedge funds sell corn during a shutdown?
It's often a risk reduction move. During periods of high uncertainty, like a shutdown, they might liquidate positions like corn just to lower their overall risk exposure. The fear is that the moment the data starts flowing again, we could see a sharp, sudden price drop in corn if that hidden selling pressure is revealed. It just further demonstrates how unstable the information flows are in the real economy right now.
Okay, so this is where the technical picture really starts flashing some warning lights, suggesting that coiled spring might be getting pretty tightly wound. The outlook seems to point strongly towards increased volatility, maybe a pullback or consolidation soon, especially given how stretched this rally looks technically.
Yeah, while the market's overall intermediate-term uptrend is still intact, you're right. The near-term technical indicators are flashing some stark warnings that, frankly, demand attention.
Well, let's start with the big one, the S&P 500 itself. Still bullish trend, but momentum looks stretched.
Exactly. The near-term relative strength index, the RSI, which for listeners measures the speed and change of price movements, basically momentum is currently reading 72.
And above 70 is the threshold, right?
Correct. Anything above 70 is generally considered overbought. It suggests the market is probably due for at least a pause, a consolidation, maybe a pullback. And we really need to monitor for something called a negative divergence. That's where the price pushes to a new high, but the RSI fails to make a new high alongside it. That signals that the underlying momentum is actually fading, even as investors are pushing the price tag higher. It's a classic warning sign.
But the main risk, the really screaming siren, seems centered on the market leader, doesn't it? The semiconductors.
Absolutely. The systemic risk centers entirely on the PHLX semiconductor index, the SOX. The SOX index is the critical proxy for the entire AI narrative, the tech megacap rally. It's been the engine. Last week, it posted a weekly gain of over 5%. Huge move. But that pushed its RSI to an extreme reading of 87.
87. Okay, let's pause on that number. 87. What does that actually mean for the listener? How bad is that?
It's astronomical. And the historical implications are pretty severe. Remember, the RSI scale goes from 0 to 100, and 87 means that over the last 14 trading days, 87% of the price movement was purely to the upside. It's just a raw measure of euphoria, of extreme buying pressure. And context is key here. This reading is a 14-year high. We have not seen the SOX RSI this high since January 2011.
January 2011. Wow. That's what, just after the market started clawing its way back from the great financial crisis?
Exactly, right after one of the deepest market crashes in modern history.
So what does that historical echo, that 14-year high, really tell us?
It tells us that such extreme overbought readings virtually guarantee what technicians call near-term mean reversion.
Mean reversion, meaning?
It has to come back down towards its average level. It's almost like a law of physics in markets. It's not just a risk of a pullback. It's practically a mechanical necessity at this point. The sector simply must pull back towards its average trading level soon to relieve that intense buying pressure. And when the single most important leading sector in the entire market hits an 87 RSI, the whole system becomes precarious.
Okay, so connecting this to the bigger picture then. This extreme overbought condition in the SOX isn't just a warning for semiconductor stocks or tech investors, it's a potential systemic risk.
Absolutely. Because the rally has been dangerously narrow. It's been driven almost exclusively by those mega cap tech and AI stocks that dominate the SOX index.
Right.
So the overall health of the entire S&P 500 is now precariously dependent on its single most overextended component. If the semiconductor generals of this rally finally pull back, as that RSI 87 strongly dictates, it creates an immediate and potentially massive leadership vacuum.
And the big question then becomes,
The central question is, are the other sectors ready? Are financials, materials, healthcare, are they robust enough right now to step up and take the baton of leadership? If they aren't ready, if that broadening participation we talked about earlier isn't strong enough yet, then the correction won't be just a healthy pullback isolated to tech.
it could be worse.
It could be much deeper and much more widespread, and it could seriously threaten the entire bull trend, potentially sending the S&P 500 crashing below key technical support levels.
And this technical fragility, this stretched rubber band, it's made even worse by the data blackout from the shutdown.
Yes, exactly. The government shutdown has delayed those critical reports we usually rely on, stuff from the Labor Department, the Census Bureau data that normally anchors market expectations. So investors are now basically operating in an information vacuum. They're forced to rely almost entirely on just two things: corporate earnings reports and, critically, every single word coming out of the Federal Reserve.
And that lack of objective data, it increases the chance of big market overreactions.
Dramatically. Any little piece of information that does manage to emerge, maybe a single Fed speech, one company's earning result, it's likely to be amplified far beyond its normal significance. It just makes for a highly unpredictable, jumpy environment.
Okay, so with that data vacuum firmly in place, the Federal Reserve, the central bank, truly becomes the only game in town this week, doesn't it?
Yeah.
Every word, every comma is going to be scrutinized.
Oh, absolutely. The main event is definitely the release of the FOMC meeting minutes. That's Wednesday afternoon, 2:00 p.m. Eastern. These minutes, they'll detail the discussions from the September meeting, which was when the Fed kicked off what the market firmly believes was the first of several rate cuts coming in 2025.
So what are investors going to be looking for in those minutes, beyond just the headline?
They'll be searching for subtle shifts in tone, the level of agreement or disagreement within the committee. They'll be scrutinizing the text for really two key things. First, what was the degree of consensus for that September rate cut? Was it unanimous? Or was it highly debated, maybe with several dissenting voices arguing against it?
Okay.
Second, they'll be looking very closely for any evidence of influence from the newer board members who are reportedly more dovish. People like Stephen Mirren, for example, who is rumored to be pushing internally for a more aggressive path of monetary easing.
So if the minutes show strong agreement on cutting rates, and maybe confirm that dovish push from new members,
Then that bad news is good news engine we talked about, it'll likely accelerate. The market will love that.
but it's not just the minutes, right? There are Fed speakers scheduled too.
A lot of them. We have a really heavy slate of public appearances throughout the week. Governors like Kashkari, Barr, Musalem, and others are all scheduled to speak.
And in this data vacuum, their words carry extra weight.
Extraordinary weight. This is basically a high-stakes communications test for the Federal Reserve. They have to manage market expectations flawlessly, especially when you remember the market is already priced for 97% certainty of another cut in October.
And that 97%, that's the central risk right there, isn't it?
It really is. If they deliver anything less than perfectly dovish guidance, I mean, if just one speaker sounds a bit cautious or maybe says they need to wait and see more data before committing,
Then what?
the repricing could be violent. Because the market is priced for perfection. If that probability of a cut drops even from 97% down to, say, 75%, the bond market could sell off hard, yields would likely jump back up.
And that crucial tailwind for stocks, the lower discount rate, it just evaporates.
Instantly. And because of the data vacuum, there's nothing else, no strong economic report to soften that blow. The market reaction could be highly punitive.
Okay, so Fed watching is absolutely critical this week. Moving on to corporate fundamentals then. The week of October 6th also marks the unofficial but really important kickoff of the Q3 earnings season. What's the overall forecast looking like?
Overall, actually pretty solid. The consensus forecast is for blended year-over-year earnings growth of about 7.9% for the S&P 500.
7.9%. That's pretty decent.
It is. And if that number is delivered, it would confirm that narrative of corporate strength we've been hearing. It would also mark the 9th consecutive quarter of year-over-year earnings growth.
Wow, 9 straight quarters.
Yeah. But this week's initial reports are absolutely essential because they'll provide the first real test of that K-shaped economy divergence we've been hearing so much about.
Right, the K-shape. Let's spend a moment on that for listeners who might not be familiar.
Yeah.
That's the idea that the economy is splitting, right?
Exactly. The top leg of the K is doing great. That's wealthy households, large corporations, they're thriving. But the bottom leg of the K, that's the median and lower income consumer, they're struggling.
And this week's early earnings reports give us a direct window into that split.
A direct test. We start with the premium consumer on Monday with Constellation Brands ticker STZ.
The Corona and Modelo guys.
Exactly. They're a key bellwether for discretionary spending, specifically by higher income households. If their sales, particularly for Corona and Modelo, are looking robust, it validates the idea that the top end of the economy is still strong. We need to focus heavily on a metric called their beer depletion trends. That basically tracks how quickly the beer is leaving the distributor's warehouse and actually getting bought by consumers. Strong trends there mean the affluent consumer is still spending freely, seemingly insulated from broader macro pressures.
Okay, so that's the top leg. Then, conversely, we look at PepsiCo PP reporting on Thursday.
Right. PepsiCo's results are a crucial, really granular gauge of the health of the low to middle income consumer. They sell staples, right? Frito-Lay chips, Pepsi soda. These are products where demand elasticity can be pretty high for families watching their budgets closely.
So what's the key thing to watch with PepsiCo?
Management really needs to demonstrate that they can successfully pass on any rising input costs, whether that's from potential new tariffs or just general supply chain inflation, without crushing demand. If they can't pass those costs on, or if volumes drop when they do, it means the average consumer is trading down to cheaper options or maybe cutting back entirely.
And the specific metric there.
You have to scrutinize the Frito-Lay North America organic volume number. If that volume growth is weak or negative, it's a very clear signal of financial stress among the median U.S. consumer who's already bearing the brunt of inflation from the past couple of years.
Okay, Constellation for the top, Pepsi for the middle bottom. And then there's Delta Airlines, also Thursday.
Yep, Delta DAL. That serves as more of a barometer for corporate confidence and feeds into that whole soft landing narrative.
How so?
It's all about their outlook on business travel demand. That's the critical indicator from Delta. If C-suite executives across the country are feeling confident about the economy, they keep spending aggressively on business flights, client meetings, corporate travel, conferences, all that stuff.
And what's the recent buzz been?
Well, recent commentary from Delta and others has actually suggested robust corporate travel continues. So if Delta confirms that optimism in their outlook this week, it really strengthens that top-down story of corporate health. And it further cements that potential divergence from the consumer weakness that PepsiCo might end up revealing.
So it really sounds like the first earnings reports of the week are setting up a direct confrontation in the data. Corporate strength and premium consumer health shown by Delta and Constellation potentially clashing with signs of median consumer stress from PepsiCo.
That's exactly the setup.
And the market seems to have fully priced in the first part, the strength, but might be kind of ignoring the second part, the potential weakness.
That appears to be the case, yes.
Okay, so wrapping this all up, what does this highly technical, really divergent, and potentially fragile market picture mean for you, the listener, who's just trying to stay strategically well-informed?
Well, given those technical extremes we highlighted, especially that incredibly rare RSI reading of 87 in the semiconductor index, I think extreme caution is really warranted in those high-flying tech stocks right now. The potential for a sharp, almost necessary mean reversion, a pullback in that narrow leadership group, seems virtually guaranteed, It's just a matter of when and what triggers it. And that likely means some pain for the broad indices they lead, like the NASDAQ and maybe even the S&P 500.
So if caution is warranted in the leaders, does that mean moving money elsewhere? A strategic rotation.
That's what strategists are overwhelmingly advising, yes. Use any pullback that occurs, whether it's triggered by a technical correction in tech or maybe a momentarily hawkish comment from the Fed, use that dip as an opportunity.
An opportunity to do what?
To diversify portfolios, move into areas that have lagged behind and might offer some catch-up potential.
Like where?
Well, the money needs a new place to go if and when the SOX index takes its mandatory breather, right? So look outside that mega-cap tech bubble. Consider U.S. mid-cap stocks, which are generally trading at historically cheaper valuations compared to large caps right now. And look at cyclical sectors, too. Things like financials, materials, maybe even healthcare. These sectors often offer relatively attractive valuations, and importantly, many have strong earnings revision trends right now, which suggests they could potentially sustain a rally if market leadership finally broadens out beyond tech.
Okay, rotation potential. We also need to keep perspective on that precious metal strategy, right? Given the record high in gold.
Absolutely. The underlying bull thesis for gold remains exceptionally strong. It's driven by that ongoing global uncertainty, those de-dollarization trends among central banks we discussed. And for investors who are looking for maybe leveraged exposure to that theme, gold mining equities could be particularly attractive right now.
Why the miners specifically?
Because their valuations, the price of their stocks, are still historically quite low compared to the actual price of the metal itself. Yet their free cash flow margins are expanding dramatically as the price of gold surges higher. So they potentially offer a way to capitalize on that defensive gold hedge theme, maybe with more upside leverage than holding the physical metal itself.
Okay, so this deep dive really shows a market that's, on one hand, powered by just overwhelming confidence in future Fed policy and the AI growth story.
Yeah.
But at the same time, it's a market that's simultaneously heavily hedged that barbell strategy and technically stretched to a point, particularly in its leadership, that we just haven't seen in over a decade.
And what stands out most vividly to me looking at the week ahead is that K-shaped reality potentially revealed by the upcoming earnings preview. The S&P 500 index right now seems to be fully validating the top strong leg of the economy. That's the corporate spending, the high-income households, the world represented by companies like Delta and Constellation Brands.
Right.
But it seems to be willfully, almost deliberately, ignoring the potential underlying weakness signaled by companies like PepsiCo, companies that cater to the broad base of consumers.
Which leaves us, and you the listener, with this final provocative thought to mull over. The stock market has clearly priced in a near-perfect scenario. A smooth, soft landing for the economy, multiple Fed rate cuts coming soon, unwavering corporate profits, and it's basing this largely on the perceived strength of corporations and wealthier consumers. Can the S&P 500, which is already technically stretched, potentially near its breaking point in key sectors, remain completely decoupled from the potentially mounting financial reality of the median consumer indefinitely?
Or will that structural weakness, hinted at by companies selling everyday staples, eventually ripple upwards? Will it force that necessary technical correction in the market leaders and potentially pull the rug out from under this entire record-setting rally? That ultimate divergence, that potential clash between the K-shaped reality and the market's current pricing, that feels like the single biggest risk factor hanging over markets for the rest of the year.